the question is now, what's the required hit ratio to make sustainable profits in the long run? And therefore, let's remove the assumption. This is the required hit ratio in this case. So it's position, and then in the evening we close the position. Then this requires on average in the long run a hit ratio of more than 51%. Now, it's important to note that the analysis here assumes that we take no actions to control our limit trades, and frequent trading doesn't necessarily mean that you cannot make profits. So it still can be profitable as long as you follow a couple of rules to control and minimize trading costs. And now in the next lecture, you will continue with an AI-powered roleplay. So roleplay is a brand new feature or lecture type that allows you to communicate you through what's important to consider. Request next. So you can decide here how you into any comment. Alright, let's jump right into the very first trade, and I'm here on the Wanda trading platform. So this course covers 2 brokers and 2 day trading platforms, Wanda and FXCM, and I've here the instrument Euro US dollar, and I can click on buy, and then I can select 100,000 units, so I will buy 100,000 euro for 116,000 US dollar. So let's click on submit. And now I have here one open position, a long position in the instrument Euro US dollar. And actually in day trading, we should close that position later on, so we can see the current unrealized profit and loss. And let's close the position here. And let's have a look. So we realized a profit of $1. And of course, making profits is the desired outcome of any trade. Now, in fact, we haven't bought 100,000 euro, and I haven't paid $116,000, so this is not a physical trade. And I just bought a derivative contract, a so-called contract for differences, and actually I receive the profit or just pay the loss of the trade once I've closed the position. So making trades on these platforms is simple, and you just need 2 or 3 mouse clicks, but you should definitely understand what you are doing, and that's exactly the purpose of the next lectures and videos. So looking forward to seeing you there. Bye. Alright, this course is all about algorithmic day trading, and you shouldn't mix up day trading and long-term investing. So these are completely different things, and let me briefly explain the differences. So this is here a brief overview, and first of all, the purpose of day trading is generating current income. So you start in the morning, and in the best case, you end up with a profit of a couple of $100 in the evening, and that's ordinary current income. And the goal of long-term investing is to accumulate wealth for the future to have income during retirement. And this leads to the time horizon. So the time horizon of day trading is 1 day or even intraday. So we start in the morning with no open positions, and then during the day we take long and short positions, and finally in the evening we close all positions for the night. And depending on the age of the investor, long-term investing has a time horizon of 10 or even 50 years. Now, coming to diversification, a long-term investment portfolio is highly diversified with stocks, bonds, commodities, and more. And here we clearly have a portfolio approach, and decisions are made on the portfolio level. Whereas day trading doesn't require diversification, and you can trade one or many instruments, but typically the goal is to make profits on an instrument level. Next, in day trading, we can take long or short positions to benefit from rising and falling prices, and the plan is actually to benefit from market inefficiencies. So day trading assumes that we can at least partly forecast whether prices will rise or fall in the next couple of minutes or hours, and therefore the source of return is alpha. So the plan is to make profits no matter if we are in bull or bear markets. And in contrast to that, the long-term investing is typically a long only, benefiting from a long-term market growth, dividends, and the price increases, and therefore the primary source of returns is beta. Next, let's have a look at the instruments. And in day trading, we typically invest into derivatives like CFDs, so contracts for differences, and this allows us to invest with leverage, and a leverage of 10 to 30 means that we only have to invest or deposit 3 to 10% of the actual investment amount. And you will see in the next lectures in detail how this works. And due to that leverage, day trading is a very risky business, and small price changes can lead to high losses. And in contrast to that, the long-term investments are typically physical investments. So you buy physical stocks and have the stocks in your portfolio. And there's typically no leverage in long-term investments. So the risk is low to moderate because portfolios are highly diversified. So these are the major differences between day trading and long-term investing. And sometimes a picture or image tells more than 1,000 words. And now let's have a look at typical images or charts for day trading and also for long-term investing. So this is here a typical chart for day trading. It's a candlestick chart, and we have some simple moving averages and more. So this is a technical chart, and each and every bar or candle here is just 1 or 2 minutes or 5 minutes. So this is very short term. And one more time, in long-term investing, we have a portfolio approach. And it's all about finding the right portfolio in terms of risk and return that is appropriate for the investor's situation and for the investor's risk appetite. So this was a brief comparison of day trading versus long-term investing. And again, this course is all about day trading, so algorithmic day trading. Thanks for watching, and see you in the next lectures. Bye. And one more time, in long-term investing, the investor's situation, risk appetite. We are coming now to an important topic, spot trading versus derivatives trading, and these are clearly two different things. And in this course, we will trade derivatives and most of the time Forex derivatives, and this means we won't make any trades in the spot markets. Now, before we move on, you should definitely understand the difference between spot and derivatives trading and why it's for our purposes better to trade with derivatives. So let's start with the simple and more common case, spot trading or spot investing. And let's assume that somebody offers you an apple for $1 and you agree and you pay $1 to the seller, and then the seller gives you the apple and you eat the apple. So that's a spot market transaction in the real world, and that's pretty simple, right? Now, if we replace the fruit apple by the apple stock, then we have a spot transaction in the stock market. So you pay money and you become the owner of an apple stock, and you can do with it whatever you like. So in the financial industry, spot trading involves direct purchasing or selling financial instruments and assets like stocks, bonds, forex, or cryptocurrencies. And typically the delivery of the asset is immediate. So spot trading occurs in spot markets, which are either exchange-based or over-the-counter. So that's the definition that you can find on Binance. And let's have here an illustrative example. So we have the buyer, and he has some money. And then we have the owner and the seller of a financial instrument. So for example, an Apple stock. And the owner actually holds a certificate of ownership. So in the earlier days, this was a physical paper. But nowadays, this is a digital paper, so to say. And then the buyer pays the full price. And he receives the certificate of ownership. So the buyer becomes the new owner, the new legal owner of the asset. And now let's have a look at some characteristics of this spot transaction. So we have a transfer of ownership. So the buyer becomes the new legal owner of the financial asset. And actually the buyer pays the full price, and that seems to be self-evident. But we will see that this is not necessarily the case when dealing with derivatives. Next, in spot markets, sellers can actually only sell what they actually own. And if the seller doesn't own the Apple stock, he or she can't sell it. And as a side note, there's the concept of short selling, which is actually not part of this course here. And finally, the major use case of a spot transaction is buy and hold. So you buy a security, an asset, and you hold it for a very long time period. And you hope for a long-term price appreciation. So this is spot trading, and now let's compare it with derivatives trading. And derivatives are financial contracts set between two or more parties that derive their value from an underlying asset. So, for example, the Apple stock or a cryptocurrency. And typical examples for derivative contracts are futures, forwards, and CFDs. So CFD stands for contract for differences. And these are not the same. And the details are different, but the overall mechanics are very similar. And actually, all these contracts have one thing in common. So it's actually a bet on the future price movement of an asset. And this is highly speculative. Now, this is a rather technical definition of derivatives trading, and now let me further explain it with an illustrative example. And the following is now a generalized explanation that applies to futures and the CFDs, so even if there are minor differences. But here in this lecture, we don't address the specifics of futures or CFDs. So we start here with a trader, and then the counterparty is typically a professional broker or financial institution. And then we have the derivatives contract, and in this contract, we have a reference to an underlying asset. So for example, the Apple stock or a cryptocurrency like the Bitcoin. And in this contract, the trader can either bet on rising prices or falling prices. So both alternatives are possible here. And then as time goes by and prices move, the contract either expires or one party, typically the trader, terminates the contract. And then depending on whether prices of the underlying went up or down, either the trader or the broker is obliged to compensate the other party. And this is also called the cash settlement of the contract. So in the unfavorable case, if prices moved into the wrong direction for the trader, he has to compensate the broker. And otherwise, if prices moved into the right direction for the trader, then the trader receives cash compensation from the broker. So that's, of course, the desired outcome. And now let's have a look at some characteristics of a derivatives trade. So typically the trader will never become the owner of the underlying asset. So there's just a derivatives contract between the trader and the broker. And as a side note, in some contracts, there is indeed a physical delivery of the underlying asset, but this is beyond the scope here of this course. So typically in our transactions, the trader will never become the owner of the underlying asset. And therefore the trader doesn't pay a price for the underlying asset, but he or she needs to post margin to collateralize the potential cash settlement obligation. So we have seen before that if prices move into the wrong direction, the trader have to compensate the broker. And at the beginning of the deal, the broker requires some collateral. And typically the trader has to post a margin, so a cash collateral. And now comes probably the most important aspect here. So typically the margin requirement is much less than the price of the underlying. And this allows the derivative traders to make high losses and of course also high profits with only few cash in the pockets. And this is also referred to trading with leverage trading. And we will see this in more detail in one of the next sections. And finally, there's another advantage of derivatives trading. So typically traders can benefit from rising and falling prices. So they can bet on rising and falling prices of the underlying asset. And this allows. All right, here's a simple example that demonstrates how spot trading and derivatives trading can work in practice. So generally, there are two possible cases. Either we can expect rising prices, but let's compare this to the derivative trader. So trader B is a derivatives trader, and he bets also on rising Bitcoin prices with a long contract in the Bitcoin worth 1 Bitcoin. So if a trader expects rising Bitcoin prices, then he should go long the Bitcoin. And if he expects falling prices, then he should take a short contract, so long and short. And now let's assume that the margin requirement is 50%. And in our case, this means 50% of 40,000 is 20,000. And the trader has to post a margin of 20,000 to the broker. And if the price moves into the wrong direction, so in our case, if the price falls, then the margin of 20,000 serves as a collar. And by doing so, he realizes a profit of approximately 5,000. So he gets a compensation from the broker, a cash compensation of 5,000 approximately. And I've written here approximately because depending on the derivative, it's not necessarily exactly the price difference between 40,000 and 45,000. So approximately 5,000. And he actually realizes 5,000, the profit 5,000 with an initial investment of only 20,000. And we can conclude here that the profitability or the return of trader B is twice as much as the trader A. So trader A invested 40,000 and the trader B only 20,000 to generate a profit of 5,000. And this is the impact of leverage. So we have here a margin requirement of 50%, and this is equivalent to a leverage of 2. Going to fall in the near future. And again, if the price, then trader B terminates or closes the contract. Rising prices, and they can sell the asset when they expect to fall. This is the reason why derivatives trading is restricted in many countries, or can be beneficial and also manageable for experienced traders. Algo day trading. Now, part 1 of this course is all about day trading, forex, indices, commodities, stocks, and more. And as this is a very practical course, our goal is to trade with real brokers. And the good news is that this course covers 3 different brokers. So I've added interactive brokers most recently. And no matter in which country you are, at least one broker should work for you. So let's have a quick look where we are. And we are in the prerequisites part. And in the next couple of sections and lectures, I will explain the mechanics of day trading in detail. So we need to understand how it works before we can define, test, and implement trading strategies. And as I said, we will cover 3 different brokers, so WANDA, interactive brokers, and FXCM. And the question is now, so why do we cover those 3? And there are probably the leading CFD and Forex brokers with a high reputation, so that's always important. And also they provide a powerful API, so API stands for Application Programming Interface, and this allows us to not only manually trade, but also to connect with Python and let Python do the job for us. One hand side, so the products slightly differ, and not all product contracts if you are located in the US. And even more important, that is not on the interactive brokers list. And create an account on interactive brokers, and with regard to United States and Canada, so you can create accounts on Wanda and also on interactive brokers. However, on interactive brokers you won't have access to leveraged Forex trading with margin, so you won't have access to CFD trading. So if you are located in the United States and Canada, and if you want to trade Forex with leverage, then Wanda might be the right choice here. Now, for many other countries, there's no clear recommendation. So typically, you can create accounts on 2 or all 3. And in my opinion, you should either select Wanda or interactive brokers because the API of FXCM is at least most recently a bit unstable. But of course, this can change. So this is the fallback solution if you don't want or you can't work with Wanda and interactive brokers. And now let's compare and let's have a look at some more pros of these 3 brokers. So probably the API stability is highest for interactive brokers, and also the available country list, so more than 200 countries. And also the number of tradable assets is highest for interactive brokers. So only interactive brokers allows stock trading, for example. And finally, coming to an important aspect, so trading costs. And we can say that interactive brokers is very cost efficient, in particular for very large trading sizes. And on the other hand side, Wanda and FXCM are cost efficient also for very small trading sizes. And this is due to the fact that on interactive brokers, we have a minimum fee or commission that we have to pay for each and every order. And this is not the case on Wanda and FXCM. So the trading costs on Wanda and FXCM are variable trading costs depending on the trade size. And this makes trading of very small trading sizes also cost efficient on Wanda and FXCM. So these are some tips for you, but I recommend that you just have a look at all 3 brokers and check which one is the best choice for you. And now finally, let's have a quick look at what we will cover here in part 1 of the course. So we will continue with section 3, day trading with Wanda from A to Z, a deep dive. And this section is meant then in section 4, I will introduce FXCM. And once again, there's no need to create accounts for all 3 brokers. So one account is totally fine and sufficient. And I will introduce interactive brokers and highlight some differences between Wanda and interactive brokers. And the same we will also do here in the section 5 with FXCM. And once again, there's no need to create accounts for all 3 brokers. So one account is totally fine and sufficient. And then in section 6, we will start with Python and the installation of the Anaconda distribution, followed by probably the most important coding section of this course. So section 7, how to avoid and debug coding errors, very important. And then finally in section 8, I will introduce API trading with Wanda, interactive brokers, and FXCM. So this is the part 1 of the course, and I'm looking forward to seeing you there. Bye. We are now able to make trades on the trading platforms. However, the plan is to trade with Python and to create Python algorithms to run our strategies. And therefore, in the very first step, we have to install Python. So in this section, I will show you how to install Python and all required packages and libraries, and how to work with Jupyter Notebooks. And actually, I highly recommend to work with the full Anaconda installation. So Anaconda is a package manager that helps us to install all required packages and libraries in the right versions. Now, in case you already have a full Anaconda installation, you can skip the next lecture. However, please make sure that you have an updated installation. So you can update your Anaconda installation with the command conda update anaconda. And in case you're working on a Windows machine, you have to enter this command in the Anaconda prompt. And on Mac, it's a terminal window. Now, in case you have a Python installation other than the Anaconda installation, I highly recommend that you fully remove the other installation. So 2 parallel installations can cause many problems, in particular on Macs. So please remove the other installation. And of course, for those who haven't installed Python yet, the next 3 lectures will guide you through the installation steps. So thanks for watching, and see you there. Bye. Alright, in this video I'm going to show you how to install Python and the Python data science ecosystem to your local device. And for many of you, this should be a repetition, but the complete beginners among you will install Python now. In the last lecture, a notebook, and either we can actually tell. So let's calculate 5 minus 2, and this shut down. And then, for example, you can one more time open test 1. And let's close again here, test 1 and the Jupyter dashboard. And depending on your system, this works slightly different. So on Windows, you have to open the Anaconda prompt. So you can search here for Anaconda prompt. So this is how it works on a Windows machine, and on Mac, on Linux, you need to open a terminal window. So if you don't know how to open a terminal window, then also here you can go to search and type terminal, and then you will find the terminal window. And now, as I said, there's a second way how you can open the Jupyter dashboard by typing here the command Jupyter Notebook. And finally, you have to press the Enter key. And also here now, you are in the Jupyter dashboard, and for example, you can one more time open test 1. All installed packages and libraries, and there. So you have to type conda list and then press command prompt. You can get a full list with all installed packages and libraries, and the right command is conda list. So you have to type conda list and then press the Enter key. Or the terminal window, and we will continue here in the next. I'm back again here on my Jupyter dashboard, and now let's create another notebook. So for example, with the name calculator. So for example, with on my Jupyter dashboard, and now let's create another notebook. So for example, with the name calculator. So let's click here on rename. Now a cell can have 2 paste cells, so let's go back here into this. More information on the command mode and the edit mode here under help and the keyboard shortcuts. And here it says that input mode, so shortcuts are actually a new cell below. And let's go again here into the first line, and with the keyboard shortcut A, shortcuts of the command mode and the edit mode. So for example, in the command into the first line, coding line number 1, and then we can also delete a coding cell in command mode by pressing 2 times the D key, so D, write code or just text, and this go in the next cell. Let's press the escape, and then we can change to markdown first header calculator, and then in the next step we could also add an image, or we could also move the cell. We were able to change to markdown mode by pressing the M key, and for example the title could be calculator, and we can also create, and then in the next step we could also selected cells up, selected cell here. So this is header number 1, and now we could also move our hash keys. We can go to header 2, header 3, and so on. And so this we can create a hierarchical structure here. So this is header number 1, and now we could also move the cell up, so to be the very first cell, and we can run the cell, and header with hierarchy is the image and image of a calculator. And with a right mouse click, we can actually copy the image, and then we have to go into the cell and make sure we can actually copy the image, And then we have to go into the cell and make sure that this is a markdown mode. And then we can simply paste the image and run the cell. And then we have now, and we could also write to save intermediate results in memory. And in Python, A and B, so we run it again, and then C is 6. And that's why the running numbers here on the left-hand side are very important, because they coding cells. And then if you run a cell that actually requires the previous cells, then very likely you will get an error here. Let me show you one more time in the very same cell. And finally, we also Hi and welcome to this very important excursus on errors and debugging. So what do you think is the most important skill in coding that any coder should have? Is it A, always coding the things right without errors? Or is it B, understanding and debugging errors? And realistically, the first one is impossible. So if you work in code on your own projects, then you will create many errors. And making errors is simply part of the game. And therefore, it's even more important that you can understand and debug your errors in the shortest possible time. And here's an example of an error. And some of you might get intimidated by such an error message. But there's absolutely no reason to throw here the towel. So it's very likely that you will fix the problem in no time. And here's another fun fact. So debugging errors can make up more than 50% of a coder's work and spend a lot of time. This course, but also in any other coding course. At least it should be one of the major goals. Now, let me introduce interactive brokers, or short IBKR, and I'm here on the interactive brokers website for the European market, so IE for Ireland. But depending on your region or your country, you should go to the right affiliate website. So if you scroll here down, then you will find information on other interactive brokers affiliates. And there you will find the websites, for example, for the US market, or for the Canadian market, for the UK market, then for Central Europe, for Australia, then India, Hong Kong, Japan, and also Singapore. Now, Interactive Brokers is probably one of the largest and most reliable online brokers in the market, and there are definitely some good reasons why you should select Interactive Brokers. So first of all, Interactive Brokers is available in over 200 countries. So there's hardly any country where you can't for your country list, and so the available. And you can also check here the country list, so the available country list, and you can also check country list. So the available country list, and you can actually have a look for your country. But again, there's hardly any country where you can't create an account here. And also in terms of available trading instruments and products, there's hardly any broker that offers the same full range of instruments. So from stocks to options, futures, currencies, CFDs, bonds, funds, and more. And you can check here the available instruments under trading and products. And for example, here for the European market, these are the available instruments. So stocks, ETFs, options, futures, then spot or cash currencies, CFDs, cryptos, metals, bonds, and also mutual funds. However, please keep in mind that the products differ from region to region or from country to country, and low commission also for our purposes and all its information. Here you will find the Traders Academy with very interesting and helpful blogs, videos, and more. Now, Interactive Brokers offers two different accounts, a paper trading account and a live account. And as the name says, the live account allows you to trade with real money, while the paper trading account is a trial or a demo account where you can test and learn with paper money, so no real money. And therefore, there's zero risk of losses. And as the paper trading account offers pretty much all features and functions of a live trading account, we will start here with the paper trading account. And actually creating a paper trading account is really simple and straightforward, so it won't take more than 5 minutes. While creating a live account takes longer, so probably a couple of days, as you have to go through the application and identification process. So I'm still here on Interactive Brokers, and then you can click on the free trial. And as I said, so the free trial includes most of the features. So you have access to all platforms, and you can get market data for probably all products. But typically the data is delayed by 10 to 15 minutes. And then once you have gained enough experience and practice, you automatically also have And then you also have to select your country, paper money, at 76,000 cash, and actually changing the again. And currently I have here. And then you have to fill in here your username and your password, and then you can select between the live account and the paper trading account. So if you have both, you can select it here. But otherwise, so for now, we should select the paper trading account. And then it says here that this is not a brokerage account. So this is a paper trading account for that this is not a brokerage. And then it says, and you can also check and 100 Amazon stocks or any other amount. So for example, 240,000 or whatever. And we will continue here in the very next lecture. Thanks for watching and see you there. Bye. I'm still here on my paper trading account, and this is actually the client portal web app, but there do exist various different trading platforms, and the client portal is here one of them. But if we check here why interactive brokers, then we can see that there are various platforms here. So depending on your experience, and the client portal is one of them, so it's an easy to use web application for beginners and also intermediate traders. And in my experience, the client portal for the paper trading account, so at least for the paper trading account, is a bit buggy. So if I go here back, then let's recall that in the last video, we have seen that I should have more than 900,000 cash here, but I can't see it now in this session. And I also can't check here